Hey everyone, in this video I wanted to discuss one growth stock that's down 82% that I think you might regret not buying on this dip. This growth stock is Chewy. So I'm going to explain using the company's revenue, profit margin, cash flow, and valuation on why I think the stock is an excellent buy right now. So let's jump right in, starting with revenue. Looking at Chewy's trailing 12-month revenue of 10.8 billion, you can see the company's grown nicely over the last 3 years. The company benefited significantly during the pandemic when people were interested more in shopping online compared to going and physically shopping in stores. Still, despite the economic reopening, Chewy has maintained sufficient amount of revenue growth. The area where Chewy struggled with is customer growth. Remember, during the earlier parts of the pandemic and in the middle parts of the pandemic, people were adopting pets at an accelerating rate. What was troubling since the economic reopening was that people were returning pets. And that was troubling because that means they're not going to be customers for longer term. And the fact that, returning pets is unfortunate to be sure. However, Chewy is still adding new customers. It's just the number of customers that are no longer customers from earlier in the pandemic are reducing at a faster rate than the company's adding new customers. And that's understandable because the accelerated pace of customers the company added during the earlier stages of the pandemic. The next thing I want to highlight is Chewy's ability to grow profit margins. What I have here is a chart of its trailing 12-month operating profit margin over the last 3 years. And in fact, if I go back over the last 5 years, you could see a very nice trend here where it's grown its operating profit margin into positive territory, 0.2%, from where it was close to negative 9%. How has the company done that? Well, they've optimized their logistical facilities. They've added automated warehouses. They've added warehouses closer to their customers, reducing the distance the items have to travel when they ship the items. So they've done a lot of little things that are showing big improvements in the company's bottom line. And you can see that as well with its cash flow from operations over the trailing 12 months. Similar story to its operating margin, where as the company has grown revenue, it's led to increases in its cash flow from operations, resulting in 525 million in cash flow from operations in the latest trailing 12-month period. And this is growing very nicely as revenue is growing, and it could be reasonable to expect Chewy to continue growing cash flow from operations for several years into the future, although perhaps maybe not at this rapid rate that it's done so in the last year and a half or so. And finally, the last reason why I'll highlight why I think you might regret not buying Chewy stock on this huge dip is because of the reasonable valuation. Given its excellent performance, it's surprising that you're still able to buy Chewy at a forward price to earnings of just 31.52. This is the lowest this stock has traded for going back all the way to January of 2022. This is arguably the cheapest this stock has ever been. And in my opinion, given its excellent performance, its ability to improve profitability, its surging free cash flow, I think you might regret not buying Chewy stock on this dip here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.